Back with the market right here on ET now and still slipping. We're down over 200 points as we speak right now. So pretty much around, the day's lows, 217 points lower. Motilal Oswal is now down about 8% in trade. Swiggy is lower by 5.5%. Cairns is down 4% in trade. Crompton is down 3.5%, and then Idea lower by 3% as we speak. Even within the large cap pool, Interglobe is now down 2.5%. Eternal has slipped about 2.5%. Bajaj Finance is down 3%. There's L&T, which is lower by 2%. M&M lower by 2%. And Shriram Finance, which has been having very good days up until the day before, that's the one which is down about almost 3% as we speak right now. But Shadowfax is under pressure after a large block deal saw over 10 crore shares, which equates to nearly 17% of the equity changing hands. Let me take it across to Avi and get in more details on who were the sellers.
So Shadowfax Technologies is in focus today as 17% of equity gets traded with 10.14 crore shares changing hands. It saw an intraday low of 6.7%, which was the biggest intraday fall after July 14th. Also important to note that the lock-in has expired for Shadowfax Technologies, under which 45% of outstanding shares are now available to trade. Some of the big holding institutions as of June 2026 are 8 Road Investments with 9.5% stake, NewQuest Asia Fund with 11.53% stake, and Flipkart with 7.29% stake. The most likely sellers in this block deal are 8 Roads, Flipkart, and IMM India Fund at a floor price of 197 rupees, which is almost a 10% discount to the yesterday's closing. Some important things about Shadowfax is that although it is down by 10% in the last 1 month, but it has almost doubled in the past 6 months. Some of the capex outlay for FY27 has been in the range of 180 to 190 crore rupees, which is the same as FY26. And the growth guidance for the coming year on the top line basis is in the range of 27 to 30%, with the hyperlocal scaling by 45 to 50% because it is on a lower base. So Shadowfax is down by about 3 to 4% because of a large block deal that has taken place and the lock-in getting expired, under which 45% of equity is now available to trade.
Okay, that's interesting. Shadowfax currently lower by 4.6%. But GoDigit came out with its numbers. Mithali is here to tell us how the quarter was.
Right, so rightly mentioned, GoDigit is under pressure today after declaring their Q1 FY27 results, with growth taking back seat to profitability. Now, the gross written premium, it has declined by 8.4%, while the gross direct premium, they have also slipped by 2.4%. The combined ratio specifically, that has deteriorated to 10.72%, and also their loss ratio, it has risen to 73.3%, mainly due to the higher motor own damage as well as the health claims. The premium decline was driven by a planned exit from the unprofitable group health, also lower crop insurance and reduced exposure to their low margin reinsurance business. Management also stayed conservative in fire insurance and have continued pruning their weaker motor segments, prioritizing the underwriting discipline over the market share. Now, brokerages, if you see, they have quite a mixed view on the stock as of now. Morgan Stanley, it has maintained an equal weight to the stock and given a target price of 328 rupees, citing weaker motor profitability as well as the market share loss. While if you see Citi, they have maintained a buy rating on the stock, given a target price of 385 rupees, saying that corrective actions have already been placed by the management and a gradual recovery is quite likely going ahead. So the focus now shifts to whether these all the pointers that they have, the corrective measures that they have implemented, how does that pan out in Q2? But as of now, we see that the stock is under pressure on the back of the results.
Okay, that's quite interesting. That's the word coming in on the GoDigit earnings. Just looking at what the large cap construct is like. And I want to revisit what Infosys is settled into and where emphasis is, of course, complete, contrast performance in terms of their earnings, or for that matter, commentary as well. Infy is still struggling lower by about 1.5% as we speak right now. And then, of course, let's bring up what Emphasis is up to. You just heard from the management, very confident. Emphasis has softened a little bit now from where it started off, and you are seeing some amount of profit taking step in. 1% lower for Emphasis now as we speak. But let's welcome on board Vijay Thadani, the Vice Chairman and MD at NIIT, joining in on the show right now to talk about how their performance has been. Mr. Thadani, great to have you today on ET Now. Thank you so much for your time. Help us understand what the quarter gone by was looking like and what kind of visibility you have going forward.
Right. First of all, we are talking about NIIT Learning Systems today. And we announced NIIT Limited a few days ago, but NIIT Learning Systems, I think we've had a decent quarter. Our revenue has gone up by 25% year on year, and EBITDA has improved by, margin is at 18.3%. PAT is also strong, and EPS is at 4.17. I think it's also backed by a large number of contracts that we have, which is we got 3 new long-term annuity contracts, and we also had a renewal of 3 very large contracts earlier, as well as expansion of one of the contracts. So very decent quarter and order intake and deals intake. And I think this is all backed by, while there is softness on the job front and the uncertainty of the environment. But that aside, I think it's the AI-led initiatives which are actually gathering momentum. And the fact that we made early investments and we've had a pole position on this, especially of AI learning, I think that's what is contributing to the whole thing. I also see on the screen that you are also sharing how different segments of market have responded to our offerings. Industrials, BFSI, and life sciences are leading. Of course, technology has always been on the forefront. But this time, technology was a little trifle slower, but not in an overall sense. So I think the outlook is looking good, but the environment is very tough. So we are maintaining the guidance that we had given of high single-digit growth for the year and margins from 18 to 20%. So that's what we have stated also. So we are very bullish about the AI-led initiatives and some new launches that we have done, which are met with some very encouraging response.
Mr. Thadani, hi, morning. Your revenue grew 25%, but organically it grew 11%. Do you see the kind of growth coming in organically going into the full year?
Yeah, see, we did 2 very interesting additions to our family, which is 2 acquisitions. One, a company in Germany, and that contributed immediately in the very first year through a major win from an auto major in Germany. And the second is a company which is in California as well as in Costa Rica, which is in AI-led outcome-based learning capabilities, building those. And there also we have had a significant win with one of our customers. So both these have contributed a great deal. These acquisitions are getting integrated in the company very quickly, and that's why we are now talking about the overall growth. Of course, the existing customers that we have, they've grown well. There was a little softness because of the exit of one large customer. That's a contract which expired or got over because that service stopped. It was in Canada with the real estate regulator. That was a large 5-year contract which went on for 8 years, but after that the government changed the law, and therefore that contract doesn't exist. So that impact is felt in the organic, but if you take that impact out, we grew 18% year on year and 5% in organic terms. So even in organic, the growth was fairly decent. But these new acquisitions and their integration in the company is also helping us a lot.
Tell me, Mr. Thadani, going forward, how much of NIIT's growth is going to be organic versus acquisition-led? Is there any indication of what that mix is going to look like?
Okay. Acquisitions, though in number they are large, but two versus one NIIT, but in impact they are very small in the first year. But we hope that because these are specific capabilities or specific geographies that we have entered in, I think over a period of time all these will become a part of the exercise, and our trajectory in the past, and we also believe in medium term we'll settle on is 20%, 20% growth, 20% margin. That's what we have historically demonstrated, other than this environment uncertainty. The AI-led initiatives and the market position we have in that space, it gives us a lot of confidence in a couple of years. Of course, environment aside, we should be back on similar trajectory.
So what is the levers that you have to move up to a margin guidance of 18 to 20% that you have enlisted for FY27? Currently, at the end of Q1, it was around 16.4%.
Well, at the end of Q1, it was 18.3%, our EBITDA margin. And we believe that during the year, it will be 18 to 20%. The reason is that one of the acquisitions or the new additions to our family, they are in the process of settling down, and as they have settled down, they have contributed this quarter itself with very good results. So I think their contribution will increase, and that will also significantly contribute to the margin. There are other efficiency initiatives, and lastly, the AI-led initiatives, which have contributed 13% to the revenue, they are typically coming in at a higher margin because of the uniqueness of our offering, as well as the specialty, as well as new business models that are emerging.
And Mr. Thadani, I wonder whether anything is changing on ground from a competition perspective, as well as from a capability perspective that your customers are asking from you in terms of AI-based learning and the like. How is that being integrated to part of the service offerings that you have?
That's a very good question. I think a number of our competitions are themselves, those who were late to the party for AI, are struggling, but I'm sure they will also find their way. But this gives us an opportunity to strengthen our market position. So our win rates are very high, and they've been historically higher, but in these recent times have been very high and good. The deal pipeline is also strong. What do our customers ask? The customers were earlier looking at L&D outsourcing as a service that they needed from us, which means they wanted their learning and development function to be run in more efficient manner and obviously at a lower cost and deliver higher benefits. Now the customers are asking for business outcomes. And I think we are very happy because then we can relate our offerings to their business outcomes and therefore our pricing in a small way as well. AI and how AI will change their life is a very important question. So the important question is, what is your strategy and what investments are you making in staying ahead of the curve? This is a discussion which we have very, very often. So in this process, we have been able to showcase some very comprehensive solutions which have made a very distinct difference to their top lines and bottom lines, direct correlation. And I think that makes them very happy. We believe that more customers will listen to that, and will respond to our offerings. And I think we should therefore have a stronger position.
I'm sure they will. Mr. Thadani, great to have you today on ET Now. Thank you as always for your time.
Thank you very much. Thank you. Great speaking with you.
Okay, let's move on and let's talk about Meesho. It's been a good quarter of earnings for this newly listed entity, or rather relatively newly listed entity. Let me take it across and get in more details from Mitali on how the earnings were.
Right, talking about Meesho, so for Q1 FY27, it was a stronger quarter if you see for the company. In terms of profitability, they are still standing at losses, but that seemed to have narrowed down for this quarter. Well, the quality of earnings that have obviously improved. The revenue for the quarter, it has risen nearly 5% on a sequential basis, beating the street expectations. But if you see on the EBITDA losses as well as the net losses, that have narrowed down, reflecting better operating discipline at the company's end. Now, what's driving this improvement is obviously the better execution, lower order cancellation, also the reduced return to origin rates, and improved platform monetization that has helped company boost their revenues, while logistic efficiencies that help them boost their margins. Platform scale, it continues to impress. If you see the net merchandise value, that has jumped 34% on a yearly basis, with 725 million orders being processed in this quarter. That is roughly 90 orders every second that they have processed. Also, the annual transacting users, that figure has climbed now to 29%, while purchase frequency also increased, signaling deeper engagement by the customers. Margins continues to improve in the right direction, while Citi, it has remained constructive in the stock, given a buy rating and set a target price of 220 per share. And Citi believes that advertising revenues, the pricing power and operational efficiencies that will continue to drive profitability over the next coming few years for company. So overall, a good quarter for Meesho coming.
Okay, stock not all that excited though. In fact, on that note, we're going to wind it up right here on this edition of The Market.
Hello and a warm welcome. You've joined us on Midcap Masala right here on ET Now. I'm Ashesha Adwaryu, and this is a show where we interact with the management of mid-cap companies. And let's get started. A whole host of companies have reported their numbers, and first on our radar this morning is Sona Comstar. We have Mr. Rohit Nanda, Group Chief Financial Officer at Sona Comstar, who is now joining us. The stock, of course, is not reacting much to its numbers, but several talk points over here with the management. Thank you so much for taking your time out and joining us here. And first, let's talk about tariffs. We'll talk about the numbers and the agreement that you signed with the Japanese company. But since the tariff announcement came just today morning, and you generate significant amount of your revenue from exports, is it likely to change your life or any impact on the exports that are done by the company?
Good morning, Ashesha. Thanks for hosting me. So our answer would be no, because last year also when the tariffs were imposed, eventually tariffs are borne by the importers. And if you look at our numbers in the last 1 year also, the exports have not been impacted by the tariffs. And this new tariff announcement also should not impact. I mean, this is based on preliminary assessment. Like you said, it was announced yesterday only. But we don't expect this to impact us in any significant way.
Okay, so no impact of tariffs, that's the word coming in. But Mr. Nanda, let's also talk about earnings. And you have reported very strong set of numbers, especially on a year-on-year basis. What aided this kind of growth for you in the first quarter of FY27?
So if you see, just below the surface, our EV revenues have more than doubled up. So that has been at the forefront of our growth. So we've done really well in terms of our domestic EV revenue growth, as well as the EV revenue growth that we generate from China as a geography. So these two have been, the driving forces behind the growth that we've seen in this quarter.
Understood. And your net order book came in at about 24,000 crores as on 30th of June 2026, which is a significant increase from the number that you had reported at the end of the previous quarter. How are demand trends shaping up for you, and what is the order inflow guidance for the rest of this financial year?
So I think order pipeline looks fairly good and strong. We do not give a guidance on the order book because, the order wins can be lumpy. There can be periods where there are no order wins, and then suddenly in one quarter you can have a big lumpy order wins. So we do not actually give order guidance as to how far and how much the order book will grow.
No guidance, but I believe structurally the trend continues to remain positive given the kind of numbers that you reported in the quarter gone by. Let's also talk about margins then. And I do understand that they were impacted because of rise in commodity costs and labor costs. Although trends have started improving in June and now in July, are margins expected to be impacted in the second quarter? And are you passing on the impact of higher costs to your customers, if at all, with a lag?
Yeah, so see, input price increases with respect to the material costs are structurally a pass-through. So customer contracts do have clauses for pass-through of the metal prices and other input materials. However, this happens with a lag. So therefore, typically an increase in the material prices, especially a sharp one, will lead to, a drop in our margins first. And then with the lag, these tend to get recovered. Apart from that, there is an arithmetic effect also on the margin because, even if we recover the entire material cost increase from the customers, in terms of the arithmetic calculation of the margins, the margin will still drop because you're adding the same value to the numerator and denominator while computing the margin percentage. In terms of margin profile, I think this is still within the guided range. Last quarter also we'd indicated that there are pressures from increased input prices, but we did indicate that it is still expected to remain within our 23 to 25% margin indicated range, and that's where it has come as well. So we expect this to stay within this range.
So EBITDA margins are expected to sustain in that 23 to 25% range despite the raw material headwinds that you've been facing over the last few months. Let's also talk about new verticals and your expansion plans then. I believe you're also looking to strengthen the railway business. Which other segments are you eyeing, and what is the timeline that you're expecting for the robo and physical AI segment to start contributing to your revenue going forward?
So we've made two big announcements. One was done on 22nd, which is with respect to our partnership with Denso. Denso, for the people who don't know, Denso is the second largest auto component company in the world. So we are partnering with them for developing and making of EV traction motors controllers for the EV and hybrid market in India. So this will include one JV in which we'll make two-wheeler and three-wheeler motors. This is something that we are already doing. We'll be transferring our current business into this JV, and Denso will come in as a 49% equity partner. Then there is a second JV in which we will be developing high voltage traction motors and controllers for four-wheelers and bigger vehicles. So this is where we will use Denso's technology. So it's a big partnership, and we really look forward to sort of taking this forward and making it big with the thrust on electrification sort of in India. In the Indian market, we expect this to really become big, and we are expecting to capture a large part of the market in the four-wheeler and bigger one. In the two-wheeler market, we are already at about 25% market share. And with Denso's sort of partnership, we expect this to further go up. So this was one large announcement which we did on 22nd when we signed the agreements with them. The second announcement is with respect to creation of a new vertical, which we are calling as Robotics and Physical AI. Now, this is something we've been talking about for some time. We, in fact, in our March quarter results last year, in fact, we had first spoken about robotics as something where we wish to get into. In terms of physical AI, if for people who track the company, they know we've been talking about epic mobility, in which intelligent and connected, in the word epic, stand for something which is related to physical AI. So the change that has happened is we have basically now we are calling this as a fourth vertical in our overall company, and we feel that this is going to be at the forefront of our next 10 years growth. Like any new segment, it may take off slowly in the first maybe 2-3 years, but then our expectation is that this is going to be a multi-billion-dollar opportunity in the years to come. And we have also announced, win of about 600 crores of orders in this quarter. So the total order book for this vertical is already standing at about 800 crores. So it's not merely announcement of a business vertical with some kind of future outlook, but we already have orders in this. We should start executing these orders as soon as within the current financial year itself.
Understood. So that's as far as 2 joint ventures are concerned that you've signed with Denso. We'll talk about that in greater detail, but let's also talk about the target that you've set for yourself. And you've said that you're looking to increase your revenue by 10 times over the next 10 years through 3 key areas. What makes you so confident of achieving this target? And I understand that this is still 9 years ahead of us. So what will the 2 to 3 year outlook look like for the company?
So, Ashesha, we normally don't give revenue guidance, so I won't be able to speak up in terms of numbers. But if we look back at our journey in the last 10 years, we've done 10x revenue growth in the last 10 years, and the aspiration is to become another 10x over the next 10 years. So basically, 100x over a period of 20 years is what we are talking about. So if you do the backward math, so that basically talks about roughly about 25% CAGR over the next 10 years. And like any other company, within this 10 years, we will probably have good years and bad years. But overall, that's the target we've set for ourselves. And given our current order book and the new sort of business verticals that we are looking at, we are reasonably confident that we should be able to get to this target. This would also include, our M&A strategy and, the organic growth pieces that we've been talking about, including railways, including robotics and AI and electrification theme, which is in India is still picking up, and globally also it has a lot of headroom to run. So we will have multiple growth drivers for ourselves.
Okay, multiple growth drivers, and that's the target that you've set for yourself for 2035. But since you're talking about Denso, does the partnership open access to Denso's existing global OEM relationships, or is it just primarily India market focused for now?
So the partnership starts with India, but it has, the headroom to expand globally. So we will start off with focus on India, but it may not be restricted only to the Indian market. So there is headroom, through discussion with the JV partners to expand it beyond India also.
Okay, so that's the view coming in. But Mr. Nanda, one last question before I let you go. Are you exploring any other such partnership with global companies?
See, since, we are a growth hungry company, so we kind of are always in discussions, both on the M&A front as well as on the technology partnerships in various areas. But we can probably talk about these things only once they've reached a certain level of maturity. So this is quite routine. We do have these kind of discussions going on at all points of time.
Understood. So that's the view coming in. Mr. Nanda, thank you so much for taking your time out and joining us here on ET Now and sharing your thoughts on what the outlook for the company looks like going ahead. Thank you for joining us.
Thank you, Ashish. Thanks for having me.
With that, we need to slip into a very short break, but we'll touch base with the management of Bank of Maharashtra in just a bit after this very short break. Stay tuned. Welcome back. You're still tuned into Midcap Masala right here on ET Now, and you've joined us on ET Now Suzlon studio. And as promised, let's put the spotlight on the banking sector. And we now have the management of Bank of Maharashtra now joining us to discuss how the results were and what the outlook is for FY27. Nidhu Saxena, Managing Director and Chief Executive Officer at Bank of Maharashtra, is now joining us. Mr. Saxena, good morning. Shesha this side, and thank you for taking your time out. And first of all, congratulations. The stock of Bank of Maharashtra has now been added to the futures and options trading with effect from 26th of August. But other than that, let's also talk about credit growth, which continues to outpace deposit growth. Is the battle for deposits becoming your biggest challenge, and how do you plan to bridge the gap between advances growth and deposit growth?
Morning, Ashisha. What you have said is not something specific to the Bank of Maharashtra, which is credit growth outpacing the deposit. This trend is visible in the industry, and I would say not in one or two, but last couple of quarters, last few quarters, the credit growth is outpacing the deposit growth. In our case, I don't see a major challenge. What we have been doing, in fact, is that we are also conscious of our margins at all times. So we have been very consciously looking at mobilizing deposits within which focus always remains on the low cost component. We have been strategically during the last 10-15 months moving away from high cost bulk, which was sitting in the balance sheet. And we have looked at alternate sources of raising resources. For example, we have done a lot of refinance transactions. Today, my refinance is almost crossed 19,000 crores. And here I get the advantage of a blended cost of 6.25 to 6.5, and where there is no CRR and SLR loading. And this helps me maintain decent margins also. So this is how we are looking at. We have kept a guidance of a credit growth of 17 to 18%, within which we are doing for this quarter also it is 24% for the domestic side. If I include my gift IBU, then the growth is 27%. And the deposit, which is to grow at 14-15%, we have grown deposits at 13%. Now, if you like, I'm just comparing for all the banks who have declared with their quarterly results or even the provisional numbers, the deposit growth for a PSP as a sector is 11%. But if you minus the CD issuances by the policy banks put together, it is 10% actually. Likewise, for private banks, the deposit growth visible to us is 14%. But you minus the CD, it is 11%. So its organic growth is 10 to 11%, wherein I have clocked a growth of 13%. So in the deposit also, we are doing better than the industry. There has been no single CD issuance in the Q1. And this also has been very consciously thought about and executed. What we feel that CD, we are not averse to do looking at the option, but it is ultimately a short-term measure. Max duration is 1 year. Also with CD, you are probably not going to get the cost advantage like I have been able to get in the refinance option. So that's how, and plus, ultimately, we are funding our credit growth with deposits and not through borrowings. So this is how we are looking at the credit and deposit side of the balance sheet.
So that's as far as the credit and deposit side is concerned. But let's also talk about credit costs, because they are now below that 1% mark. Is this the new normal, or should investors expect normalization as the loan book matures for you?
So we are very, very conscious on the asset quality. The new onboarding, in whether it is a RAM segment or a corporate, we are very positive around what is the loan book that we are building today. It should comprise of good quality borrowers. So that takes care of the future. As regards the credit cost, today our guidance is to maintain it below 1. I am 0.99. But if you look at the credit cost as per the IRAC norms of the Reserve Bank, it is actually 0.40. So 0.4% is what my credit cost is. What is happening is I am also having a net NPA of 0.13, which is lowest probably in the industry today. And whenever any fresh slippages we are encountering, against the requirement of 15% around, I am providing 100% upfront. So that is the reason why the credit cost looks 0.99 kind. But if I look at the IRAC norms, we are a credit cost of 0.4%, and overall guidance to investors has been to maintain it below 1.
Understood. And with ECL norms approaching very soon, Mr. Saxena, do you expect any meaningful impact on profitability or capital allocation as a result of this?
Shisha, we have been very closely tracking the guidelines and what is the impact going to be on us. So our calculations were in place, and even when the draft guidelines were there, the sense that we have drawn is 2,500 crores is what I would like to be providing for ECL. And what it translates to almost, because RBI has given a glided path of 4 years. You can do this up to 31st March 2031. So with that glided path given, we had worked out that my requirement towards ECL is going to be around 100 crores on a quarterly basis. As against that, even when the drafts were there, we have front-ended, we have done a 250 crore ECL provision. And as I just explained that we are actually providing more than the IRAC whenever we encounter fresh slippages. So our transitioning to the ECL framework will be very seamless, very smooth. I don't see any challenge on my profitability numbers, OP, NP, because of the ECL provisions. Well within our operations, whatever we are garnering, we will be able to make provisions. Rather, we are already advanced our provisions, and we like to do that to give the investors also that comfort that ECL is not a challenge for Bank of Maharashtra.
Okay, and your capital ratios also continue to remain healthy, Mr. Saxena. But you have kept the option of raising equity open. Under what conditions would you actually tap the market to raise equity?
So, Ashisha, what happens is, while you rightly observed, our capital adequacy is at a healthy number of 18% plus. But annually, during the beginning of the FY, we will go to the board and submit our capital raising plan for the full year. Then we have a process to take a regulator and the government approvals and the shareholders approval. So we will do all that and take the enablers, keep the enablers with us. As of now, there is no urgent, pressing need to raise equity. But I have approval to do a 7,500 crores of capital raising, both in the equity and the debt segment. But whether I will exercise the option, since I'm already adequately capitalized at 18.13%, there is no urgent need to raise money even for growth. We are able to sustain without any further equity raising. But as I said, we keep the enablers at the opportune time. If we see some opportunities and using the opportune mode, then we will decide during the year. With the approval in place, it is not mandatory that we will do the raising. But we do keep the enabler at the beginning of the year. Every year we do that.
Okay, so not mandatory that you will go ahead and tap the market, but you have just kept the option open. Meanwhile, Mr. Saxena, you're already operating close to a 2% return on assets. Should investors start thinking of Bank of Maharashtra as a structurally 2% ROA bank rather than a 1.7 to 1.8% ROA bank? Can we, change the ROA guidance in that case?
So our ROA guidance for the last 2 years, where I've been sharing at the beginning of year guidance to investors, is to maintain a ROA of 1.75, and which is a healthy, decent number, I must say. But if you see actuals, we have been overperforming. In fact, March 26 Q4, we did a ROA of 1.97. So aspirations are there to be seen as a bank which is in the ROA, 2 ROA kind of a club. But I want to go this path in a very calibrated manner. We know there'll be some quarters where you will see plus minus. I have ROA of 1.90 for this particular quarter, Q1 of FY27. There have been two reasons. My cost of funds went up by 5 pips. We had done some MCLR cuts during the last FY. This Q1 became the quarter where we had the full impact. But having said that, we have in fact upped our ROA guidance from 1.75 to 1.80. So as I said, while we aspire to be in the 2 ROA club, but we will like to do it in a calibrated manner. Against ROA guidance of 1.75 for the last 8 balance sheets, we have now upped the guidance to 1.80, and we will be continuously aspiring to perform over the guidance number. With 1.90 actual done in Q1, we are 10 bits more than the guidance. So that's how we would like to take it, ROA.
Right. So that's the guidance as far as return on assets is concerned. Mr. Saxena, thank you so much for giving us such elaborate answers and joining us here on ET Now with your outlook on what FY27 and the years ahead could look like for Bank of Maharashtra. Thank you for joining us today. With that, it's a wrap on this edition of the show. Thanks so much for tuning in. Buy now, sell now. We'll take all the market action forward. Stay tuned.